You know, in this business of trading, people like to imagine the market as some kind of living beast, wild, unpredictable, ruthless. But the truth is, it's often our own minds that lead us into the traps we fear most. And that's why today I want to talk to you about something your brain does without asking your permission. It clings to one familiar pattern and calls it safe. Before we go further, let me tie this to something you might remember from the previous video on identify early market signals, because this idea sits right on top of that foundation. Now, when I first started out, I wasn't any different from you. I stared at the tapes, looked at the charts, watched prices dance up and down like restless horses, and every now and then a pattern would show up, maybe a quiet pullback, maybe a steady rise that looked almost too clean, and I'd think, there it is. I know this one. I've seen it before. Tell me, haven't you felt that same little spark of recognition? That tiny voice whispering, this looks familiar, this looks safe. That's the trouble with the human brain. It loves familiarity. It loves comfort. It loves repetition. The market doesn't care about that, of course. The market couldn't care less about your comfort. But your brain, your loyal, misguided partner, wants to hold on to the one pattern it understands. That pattern might have worked last month or last year. It might have worked in a bull run where everything was floating upward like corks on water. But markets change their moods faster than traders change their minds. And yet, when that old pattern shows up again, you feel a tug, don't you? You feel the temptation to trust it, even before you fully analyze it. I spent years watching traders fall for the same mistake. And I'll admit, I did it myself more than once. A trader sees a little dip, soft, harmless, like a cat curling up to sleep, and says, that's my buy point. But they don't ask whether the broader market is weakening. They don't look at the character of the decline, the volume behind it, the speed of the movement. They don't ask the most important question, is this the same pattern as before, or just a look, I like wearing yesterday's clothes? Ever ask yourself that? Your brain tries to protect you by clinging to the familiar, but the market rewards only those who study what's actually in front of them, not what used to be there, not what they wish were there. Think back to what we talked about in that earlier video on identifying early signals. Remember how the first clues often show up in the subtle shifts, not the big ones? Well, the same applies here. The moment you assume a familiar pattern means safety is the moment you start ignoring the early warning signs telling you the ground is shifting. I used to say the market is never wrong, opinions often are. But here's something I learned later: the pattern isn't wrong either. It's your meaning attached to it that's wrong. A pattern that once meant opportunity may now signal danger. A pattern that once led to profit may now lead you straight into a hole you'll need months to climb out of. So let me ask you, how many times have you traded a pattern simply because it felt comfortable, not because it was confirmed? Now, don't misunderstand me. Chart patterns are real, and they matter. A market has rhythms the way a city has traffic. But the moment you treat a rhythm as a rule, you're no longer a trader, you're a passenger. And passengers get taken wherever the market decides to throw them. Inside every successful trader is a kind of quiet skepticism. A willingness to say, I know this setup, but let me test it. Let me measure it. Let me see if the market is speaking the same language it spoke last time. That's the difference between following a habit and following a strategy. Have you ever noticed how much money is lost simply because someone refused to ask an extra question? The brain likes shortcuts. Patterns that feel safe because they reduce thinking. But trading is one profession where shortcuts carry a heavy price. A pattern isn't safe because it's familiar, it's safe because it lines up with the overall market environment, the trend, the volume, and your own rules for confirmation. If you really want to build wealth, slowly, steadily, honestly, you can't rely on that instinctive comfort your brain keeps pushing toward you. Wealth in trading comes from discipline, not warmth. It comes from respecting the market's ability to shift its behavior overnight. It comes from treating every pattern like a fresh piece of evidence that must be examined, not assumed. And somewhere in the middle of all this, you might start noticing something interesting. When you stop assuming a pattern is safe, just because you've seen it before, you begin noticing the early signs that something else is happening beneath the surface. That's exactly what ties this principle back to the earlier lesson about picking up early market signals. Because the moment you stop trusting the pattern blindly, you start paying attention to the clues that either confirm it or contradict it. Isn't it strange how the moment you stop trusting the chart is when you really start seeing it? You want to know how seasoned traders survive. Not by memorizing every pattern, not by clinging to one technique. They survive by staying awake, by letting the market tell the truth, instead of forcing it to act out a story that feels comfortable. Have you ever looked at a chart and realized you were seeing what you wanted to see, instead of what was actually there? That's your brain again, trying to drag you toward the familiar. And if you don't train yourself out of that instinct, the market will do it for you, with a lesson written in red ink. Money mindset isn't about confidence. It's about neutrality. It's about saying, I don't need this pattern to work. I don't depend on it. I'll take it only if it proves itself worthy. A trader with that mindset doesn't chase, he waits. He doesn't flinch, he observes. And he doesn't assume safety, he earns it through verification. The first keynote is that your brain is wired to trust whatever it has seen work before, even if the circumstances have completely changed. That simple truth sits at the center of more bad trades than most people care to admit. You look at a chart, you see a shape you recognize, maybe a pullback that once gave you a clean entry, maybe a breakout structure you rode for a solid win, and without realizing it, your mind leans toward trusting it. It leans toward familiarity as if the market owes you a repeat performance. The strange thing is that you don't consciously decide this. It happens behind the scenes, quietly. The same way muscle memory moves your hand before you think about it. And if you don't catch yourself in that moment, you'll mistake comfort for confirmation. A trader should always question the feeling of comfort. That feeling is usually the first sign that you've stopped observing and started assuming. Think about how many times traders jump into a setup simply because it resembles one they profited from before. They don't check the broader trend thoroughly. They don't examine whether volume is supporting the move. They don't ask whether the market is in a completely different mood than it was during the last instance of that pattern. They just latch onto the visual memory. It's almost like the brain is whispering, relax, you know this one. Even though markets don't reward relaxation, they reward verification. If you've been trading long enough, you've probably felt that pull yourself. You recognize something that once worked, and your whole system wants to believe it'll work again. But pause for a moment and ask why that instinct shows up. The human brain is designed to conserve energy. It wants efficient shortcuts. In everyday life, shortcuts help you survive. They help you avoid rethinking things you already know. But in markets, shortcuts are a trap. What feels safe neurologically is often dangerous financially. The safest decisions in trading are based on evidence, not memory. This tendency to trust the familiar is especially strong during volatile times. When the market becomes chaotic, your brain goes hunting for something steady, something known. So when it spots a pattern that once gave you clarity, it clings to it like a lifeline. The problem is that volatility changes the meaning of patterns. A pullback in a strong uptrend is different from a pullback inside a weakening market. A breakout in a momentum phase behaves differently from a breakout during distribution. Two charts can look identical, but the context behind them isn't identical at all, and context is where trades live or die. Traders who don't understand this fall into a repetitive cycle. They say, but this setup worked last time, as if the market should respect their personal history. The market has no memory, but your brain does, and that memory becomes your blindfold if you're not careful. A chart pattern is not a promise. It's only a clue, and clues must be tested. A familiar pattern should make you more alert, not more trusting. It should make you examine the surrounding conditions more carefully, not jump in more quickly. There's another layer to this too. When a pattern gives you a big win, it leaves an imprint. Wins carve deeper grooves in your thinking than losses do, because they reward your behavior. Your brain stores that memory not only as, "this worked," but also as, "this felt good," and anything that felt good is even harder to question. That's why traders often misinterpret excitement as confidence. They label it intuition, but really it's memory dressed up as instinct. True intuition in trading comes from thousands of hours of observation, not from repeating something that worked once or twice. If you want to grow as a trader, you have to learn to interrupt your brain's automatic trust. When you recognize a pattern you've traded before, instead of moving toward it, step back and challenge it. Ask yourself whether the market conditions now match the environment in which that pattern originally worked. Ask whether the trend is healthy, whether institutions are participating, whether the volume aligns with the move, whether the volatility is supportive or disruptive. The more questions you ask, the more you weaken the pull of familiarity. A pattern should never be treated as safe by default. Safety in trading doesn't come from a repeating shape on a chart. It comes from alignment between the pattern, the market environment, and your rules. When all three line up, you have a trade worth taking. When even one of them disagrees, the safest move is often to stand aside. Standing aside may feel uncomfortable because your brain wants action, but profitable trading is built on patience, not activity. Over time, as you gain experience, you'll start noticing how different the same pattern becomes in different market phases. What once looked like a reliable opportunity in a trending market might transform into a trap in a choppy one. What once served as a clean entry might now serve as the start of a distribution cycle. When you start seeing those differences, that's when you know you're no longer trading from familiarity, but from understanding. And understanding is the closest thing to safety a trader can have. Your brain will always lean toward what it knows. That's human nature. But your job as a trader is to lean toward what the market is actually doing, not what your memory wants it to be doing. When you begin checking your assumptions, questioning your comfort, and verifying every familiar pattern through the lens of current conditions, you shift from being guided by habit to being guided by skill, and that shift is where real progress begins. Your brain confuses familiarity with reliability in the market, and that single mental shortcut quietly shapes more trading decisions than most people ever admit. When you look at a chart and spot a pattern you've seen before, a smooth pullback, a rounded base, a clean breakout shape, your mind immediately reaches for the comfort of recognition. It says, "I know this one. I've traded this before. I understand how this usually behaves." That's the point where familiarity slips in like an old friend and convinces you that recognition equals safety. But reliability in trading has nothing to do with how many times you've seen something and everything to do with whether current conditions support it. The brain doesn't naturally make that distinction. It operates by shortcuts, and familiarity is one of the strongest shortcuts in the human psychological system. When traders glance at a chart and feel that quick sense of ease, that is usually the familiarity effect at work. It's not analysis, it's memory. It's not objective reasoning. It's a pattern your brain stored because it once rewarded you. If you made money from that setup before, the brain magnifies it. It builds an emotional attachment to that pattern. The trouble is, the market is not a static environment. A pullback doesn't behave the same during a strong uptrend as it does during a choppy sideways environment. A breakout means one thing during high momentum and something completely different when volume is drying up. But your brain doesn't naturally scan for context first. It scans for recognition. It wants the pattern to mean what it meant before. This is one of the most subtle ways traders get trapped. They think they're being disciplined because they're following a setup they know. But what's really happening is that they're following a memory instead of the market. You've probably had moments where you said to yourself, "This looks just like that winning trade I had a few weeks ago." And before you knew it, you were placing an order. But if someone asked you, "What's the state of the broader trend right now?" you might not have had a clean answer. The brain loves to skip the deeper evaluation because deeper evaluation takes energy. Familiarity takes none. The danger grows even larger when you've had a strong emotional experience tied to a pattern, like a big win. Emotional memory is sticky. The brain holds on to it like glue. That win becomes part of a mental reference file, and the next time the pattern shows up, the brain triggers that old emotional echo. You feel confident, sometimes overly so. Confidence feels like clarity, but the two are not the same. The brain can make you feel confident even when the underlying conditions do not deserve that confidence. That's how familiarity quietly disguises itself as reliability. Another subtle element is that familiarity removes the sense of perceived risk. When you analyze something new, your mind instinctively steps carefully. It checks, double-checks, questions, evaluates. But when you analyze something familiar, your guard drops. You stop looking for danger because your brain already filed the pattern under safe. That internal shift is invisible unless you're trained to watch for it. And in trading, the moment you stop checking your blind spots is usually when the market hits you from the side. Familiarity also shortens your decision, making process in ways that feel efficient but are actually hazardous. A familiar pattern triggers a quicker emotional response. You hit buy or sell faster. You assume you already know what to expect, so you stop seeking confirmation. You stop asking whether the market is aligning with the idea, and once you stop asking those questions, you stop noticing all the little details that make the difference between a valid setup and a disguised trap. Reliability requires evidence. Familiarity only requires memory. The worst part is that the market knows nothing about your past with a pattern. The chart doesn't care what you once made or once lost trading it. The pattern might look the same, but the forces underneath, volume, sentiment, risk appetite, trend strength, liquidity, could be completely different. The brain doesn't naturally account for that unless you force it to. It takes conscious discipline to break the illusion of safety that comes from familiarity. Reliability must be earned every single time you take a trade, no exceptions. Familiarity also encourages narrative thinking. You start telling yourself stories. This is the same kind of dip as last time. Or, this type of breakout usually runs. Or, this reminds me of that winning setup. The brain loves stories because they provide closure and reduce uncertainty. But the market is not a story. It's a constantly shifting set of probabilities. When you lean on the story instead of the data, you're no longer evaluating the present. You're projecting the past onto it. That projection makes you blind to changes that matter. To separate familiarity from reliability, you have to deliberately slow down the instant recognition response your brain gives you. You must treat every pattern like it's brand new, even when it looks identical to something you've seen dozens of times. Look at the trend conditions. Look at volume. Look at volatility. Look at broader market tone. Look at how price behaves around key levels. These elements determine reliability, not the graphic shape of a pattern alone. The shape is just the doorway. The internal structure is what tells you if it can hold weight. When you train yourself to evaluate the full environment instead of trusting your memory, you start noticing how often familiar patterns fail in the wrong conditions. You develop a healthier skepticism. You begin requiring proof every time. And in trading, that habit becomes one of the strongest forms of risk control a person can build. You slowly disconnect the emotional charge from familiar setups and replace it with objective reasoning. You stop feeling drawn to a trade simply because you recognize it. Over time, this mindset helps you trade with clearer eyes. You stop confusing the comfort of familiarity with the confidence of solid analysis. You stop assuming that what worked before must work again. You start demanding evidence from the market before you trust a setup, even one you've historically loved. That shift is subtle, but it changes your entire approach to trading and reshapes how you read every chart you encounter. Your bias for certainty blinds you to shifting market conditions, and most traders don't even recognize when this is happening because certainty feels like safety. The mind always searches for something that looks stable, repeatable, familiar. It wants a pattern it can lean on, something predictable enough to calm the internal noise that comes with risk. But the market is not built on certainty. It's built on movement, behavior, psychology, pressure, imbalance, and constant change. And when a trader depends on certainty instead of observation, they start trading their expectations instead of the actual price action in front of them. This is where the trouble begins, because a trader who values feeling right more than being accurate ends up ignoring every clue telling them the market is shifting. The brain gravitates towards certainty because it reduces cognitive load. It's easier to decide, this looks like the same setup as last time, than to ask, is this truly the same structure, or am I forcing a match? That second question requires effort, patience, and humility. The first one requires nothing but comfort. But markets reward study, not comfort. A trader who becomes addicted to certainty won't notice when volume is drying up, when trend strength is fading, when volatility is increasing, or when buyers and sellers are behaving differently than before. They'll focus only on the pattern they think they recognize and overlook all the environmental changes that actually matter. Think of how many times a trader buys into a breakout simply because breakouts work the past few weeks. They don't consider whether the larger market is becoming overextended. They don't check if major indices are losing momentum. They don't examine whether the range is tightening, signaling indecision rather than strength. They see a pattern that once gave them certainty, and they rush toward it like a person grabbing the same tool for every problem, hoping it fixes whatever is in front of them. When certainty becomes a habit, observation becomes optional, and optional observation is the root of nearly every preventable trading loss. Another problem with the bias for certainty is that it tricks traders into believing the market owes them repetition. If something worked last month, they expect it to work again. If a setup looked clean yesterday, they expect today to behave the same way. But the market doesn't repeat for your convenience. It repeats only when the psychological and structural conditions are similar enough, and most traders never check whether those conditions still exist. They assume a similar shape on the chart means the same opportunity, even though the underlying forces may be completely different. Two patterns may look identical, yet one forms in a trending market and the other in a weakening one. One forms on high conviction volume and the other on scattered participation. One forms when institutional money is active and the other forms when the big players step aside. But the trader driven by certainty doesn't dig beneath the surface. They trust the appearance rather than the substance. The more a trader relies on certainty, the more blind they become to change. They start ignoring subtle clues, like slower follow-through after entries, smaller candles during trends, more wicks on both sides of price, and delayed reactions at key levels. These are all signs the market is shifting character, yet a trader locked into certainty will call them noise, instead of what they really are, warnings. Markets rarely flip from strong to weak in one violent move. They transition gradually, quietly, through friction and hesitation. Only traders watching with an open, uncertainty-tolerant mindset notice these changes early enough to adapt. There's also an emotional trap here. Certainty feels good. It gives you a false sense of control, and traders love control. When you think you've found something reliable, your confidence rises. You feel disciplined. You feel like you've figured out the game, but confidence based on assumed certainty is fragile. When the market shifts, that confidence shatters quickly, and instead of adjusting, many traders double down. They refuse to accept that conditions have changed because doing so would mean admitting their pattern wasn't as safe as they believed. This is how small losses become big losses. It starts with a refusal to let go of the illusion of certainty. To protect yourself from this blindness, you must begin treating uncertainty as part of the job rather than an enemy you need to eliminate. Uncertainty makes you double-check. It makes you examine context. It forces you to ask whether the market today is the same as the market the last time that pattern worked. When you embrace uncertainty, you trade what you see instead of what you expect. You become flexible instead of rigid. You adapt instead of insisting. You stop assuming the market is supposed to behave a certain way simply because it behaved that way before. And once you stop demanding certainty, you start seeing the truth of the market more clearly. A trader who resists the bias for certainty becomes someone who reads the market instead of predicting it. They become someone who questions, observes, listens. They become someone who can spot shifts in character early, long before the average trader notices anything has changed. They develop a mindset where every pattern must prove itself in the current environment, rather than being trusted blindly based on past performance. And once that mindset takes root, the trader begins to notice details they never saw before, details that were always there but hidden behind the comforting illusion of certainty. Your mind has a way of slipping into comfort when it sees something familiar on a chart. It doesn't announce it, and it doesn't ask your permission. It just nudges you toward the choice that feels easiest, the one that seems least threatening, the one you've taken before. But comfort is one of the most expensive luxuries in trading, and if you don't learn to question it before you put real capital on the line, you'll find yourself paying tuition to the market again and again. When you train your mind to pause, to doubt, to verify, you create a layer of protection that most traders never develop. And ask yourself honestly, how many of your losses came not from a bad setup, but from trusting a comfortable one too quickly? You see a familiar pattern appear. Maybe it's a clean pullback, maybe a tight consolidation, maybe a breakout shape you've traded 1,000 times. Your brain lights up before your logic does. It says, "This is safe. You know this?" That autopilot response feels efficient, even responsible. But trading isn't about doing what feels smooth, it's about doing what's proven. Comfort is not proof. Comfort is not confirmation. Comfort isn't a strategy. It's just a reflex. And a trader who trades by reflex is walking blindfolded into moving traffic, hoping the pattern plays out like it did last summer, or last week, or yesterday. Have you ever taken a trade and realized later you didn't actually analyze it? You just recognized it? That's the psychological trap. Your brain is built to conserve energy. It avoids uncertainty. It avoids effort. It gravitates toward patterns it already understands. This is great for everyday life, but in markets, it can get you into trouble. Markets evolve. Trends shift. Volume changes character. A pattern that worked beautifully when the market was liquid and smooth may fail completely when the environment tightens or turns choppy. If you don't stop to question the comfort you feel, you won't notice the subtle changes that turn yesterday's opportunity into today's trap. And when the trade goes against you, it rarely feels like bad luck. It feels like betrayal. But was it the market betraying you, or was it your brain making assumptions you didn't inspect? To question comfort means to slow down the moment your mind tries to speed up. It means catching yourself in the act of thinking, "I know this setup," and instead asking, "Do I know it, or do I just recognize it?" That distinction alone can save you more money than any indicator or strategy ever could. Recognition is fast. Confirmation is slow. Recognition is emotional. Confirmation is analytical. Recognition is in your bones. Confirmation is in your rules. Traders who rely on recognition alone end up stuck in loops, repeating the same mistakes, wondering why the market keeps punishing them. But the market isn't punishing familiarity. It's punishing assumptions. Think about how many times you took a comfortable trade and skipped a step of analysis because you felt like you didn't need it. When you question comfort, you're not doubting your abilities. You're sharpening them. You're forcing your mind to earn the right to act. It doesn't mean you distrust every pattern. It means you verify every pattern. That shift alone makes you slower to pull the trigger, but faster to identify danger. It prevents you from jumping into a move simply because you've seen a similar one in the past. It pushes you to check volume, to check context, to check whether the trend aligns with the setup, whether the market tone supports the move, whether the risk justifies the attempt. When you start doing this consistently, the difference in your trading becomes obvious. You stop making impulsive entries and start making intentional ones. Isn't it strange how much clarity appears when you force yourself to hesitate for just a few seconds? Over time, this habit reshapes your trading psychology. You become someone who refuses to be lulled by familiarity. You become someone who treats every setup like new terrain, even if you've walked it 100 times. And that's exactly the mindset that keeps traders alive during market transitions. When conditions change, the trader who trades from comfort gets blindsided. The trader who trades from verification adapts. Adaptation is a form of self-defense in the markets, and questioning comfort is the doorway to it. You start seeing when a pattern is losing its reliability. You spot subtle shifts in momentum that others ignore. You catch weaknesses beneath the surface long before they show up in price. And all because you refused to let comfort speak louder than evidence. There's another benefit you might not expect. Questioning comfort strengthens your emotional discipline. When you stop acting automatically, you stop reacting emotionally. Comfort trades often carry invisible expectations. This should work because it's worked before. When the trade turns sour, those expectations explode into frustration or disbelief. But if a trade is taken through deliberate questioning and confirmation, you walk into it knowing the full conditions. There's no illusion of guaranteed safety, no subconscious promise your mind made without your consent. You're clear-eyed, focused, neutral.